Amid volatility and concerns surrounding the banking industry this year, investors and businesses are turning to private lending firms like Blue Owl Capital for alternative investment management. Joining us now to discuss the emerging trend and their latest quarterly earnings, Blue Owl Capital co-CEO Marc Lipschultz. Marc, you guys have seen impressive growth. Your assets under management, $149 billion? They've about tripled since your IPO in 2020. What is going on? For people who are not familiar with this private credit market, give us sort of the overview. What has gone on here that has caused this explosion?
Well, first, thank you so much, Julie and Diane, for having me. I really appreciate the chance to chat about it. You know, what's causing the growth is private lending, direct lending. The Blue Owl solutions deliver value. Like any product in the market, financial products are just that, right? They're innovative products that compete in a broad marketplace. And direct lending is really, if you take a step back, it's essentially offering what the banks we all picture of old providing, which is making a loan, being a partner to the business, and being a long-term partner to that business and able to work through changes in the world together. So we're really a non-bank bank. We don't have any depositors, so there's no risk to the system. There's no systematic risk. There's nobody on the hook besides us and our investors. And we're just trying to make a great risk reward for our investors. And the reality is the growth reflects the fact that we have a value proposition that works for the people that provide capital, an outstanding risk reward for the people that provide us the capital. And we have a great value proposition for the people that use the capital. We're a long-term partner that gives them the privacy, predictability, and partnership they want in a lender.
Speaking of the people who need the capital, one of the things that we saw with regard to the regional banks is they support a lot of small businesses. Did you find an influx from small businesses seeking an alternative kind of investment platform?
So our whole business is designed, and our product suite is designed to lend capital to private companies here in the U.S. So absolutely what many people would constitute as the maybe middle marketplace overall. And with the change at SVB, no doubt it directionally moved more companies toward what we do. The thing about the banks in the U.S., regional banks included, is a while ago they made largely a decision not to really be lenders to these companies, these what might be considered sort of the smaller companies.
Yep.
And they made a decision a while ago not to be in that business. And even the biggest banks really are in the syndication business, right? They're in the business of intermediating loans. And so that already had been happening. It certainly accelerated further with SVB. And yet again, another reminder that at the end of the day, what you really want is long-term capital matched for long-term needs. That's what we do. We have capital that we have for the long term, so we can lend it for the long term. And it's happened time immemorial. When you take short-term capital and you try to do long-term things with it, at some point that ends up falling apart.
Speaking of falling apart, this growth in the private credit industry has not come without concerns and questions about the scope of this lending that is happening outside of the traditional bank system, especially in a rising interest rate environment. How do you address those types of concerns?
So look, whenever there's an emerging marketplace, it's worth asking those questions. So to be clear, they're perfectly sound questions. At the same time, I think often the critics, if you will, or the skeptics, say abstract kind of open-ended things like, well, you just don't know. Well, I mean, we just don't know if we live in a simulation either. So what we have to do is look at the facts. And the facts of the matter are pretty straightforward. We take capital, again, as I said, that we have tied up for the very long term. We make fundamental credit decisions with that capital, and we lend that capital to what we think are really great companies for the long term. And the evidence, however, is there that we know this model works. And that doesn't mean every single loan works for every single company. In fact, that would be a pretty poor result, right? We're supposed to be in a marketplace where there's a modicum of risk and return engaged. But take Blue Owl. We have lent $75 billion since inception. And you know what our loss rate has been? Annualized at 6 basis points. And in our software business, which is our biggest area, our specialty, we've never had a loss in one of those loans. Now, those are extraordinary numbers by the measure of direct lending. And of course, can't be lower than zero, so they can only increase. But they only have to increase moderately because we have very diverse portfolios with very good companies. So I certainly understand the question, but also importantly remember, because it's between us and our investors and the borrower, that's where it stops. So even if someone in this marketplace does a not particularly good job, first off, what you're talking about are having some challenges. Then, as a senior secured lender, you're the top of the stack. That is to say, you're the first one getting recovery. So then the question is, well, okay, do you get all of your money back or not? When you finish doing all that math and then realize it's not connected to the rest of the system, you don't have this cascade risk that others have, that you'd have in banking.
I guess it depends on who your investors are.
Well, it does. Our investors are extremely large pension funds, sovereign wealth funds, foundations and endowments, and then a large range. We've created access points for individual investors to participate. So this is a widely diversified pool of investors. And again, key point being, they're not guaranteed by anybody. It's not a deposit where the government has to step in.
So can I ask you, I want to ask you this question because banks are taking notice of what is happening in the private credit space, right? They want a piece of the action as well. Is a big bank friend or foe to you if they want a piece of that action?
So I would proffer that they're friends. And I appreciate that often the storyline is more banks versus the private lenders. But two observations. One, we certainly work closely with the banks. They've been critical partners of ours from day one and will continue to be. I would also say that for a vibrant economy, for a vibrant capital marketplace, it's not an or, it's and. Listen, this is a multi-trillion-dollar industry, right? This credit marketplace. We're small by that measure, not just Blue Owl, but Blue Owl and all of us taken together are a minority portion of that marketplace. So to have a vibrant marketplace and a vibrant economy and good capital formation, we need a really healthy syndicated market, bank-based market, and we need a really healthy private market. We've proven that too, because during the pandemic, during 2022, when the war broke out in Ukraine, during SVB, we were there providing capital. So we're providing capital at times when often the marketplace, the traditional marketplace, will not. So taken together, frankly, we've made the capital system, the banks plus the private lenders, that much more durable. That's a good thing.
All right.
Marc, thanks for coming in. Marc Lipschultz, co-CEO of Blue Owl Capital. Appreciate your time this morning.
Thank you for having me. Deeply appreciate it.